Good morning. If you've been watching the silver market, you've likely noticed something unusual. Despite unprecedented global debt levels, despite central bank policies that would have once seemed impossible, despite industrial demand reaching all-time highs, silver prices remain remarkably suppressed. This isn't a sales pitch. This is a conversation about timing, preparation, and understanding what happens when fundamental realities finally overtake market pricing. Today, we're going to examine why the current silver market represents a critical juncture. Not because prices are guaranteed to explode tomorrow, but because the conditions supporting current valuations are becoming increasingly unsustainable. The window for strategic positioning is narrowing, not closing, but narrowing. And the difference between those who prepare thoughtfully and those who react emotionally could determine financial outcomes for the next decade. Let's begin with the facts. Silver occupies a unique position in global markets. It functions simultaneously as a monetary metal, an industrial commodity, and a store of value. This triple role creates complexity that many investors fail to appreciate. Unlike gold, which trades primarily on monetary concerns, silver's price reflects industrial demand patterns, investment flows, and monetary policy responses all at once. Currently, silver trades at prices that seem disconnected from underlying fundamentals. When we examine production costs, industrial consumption rates, and historical price relationships, today's valuations appear anomalous. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has spent recent years at levels historically associated with economic crisis or severe market dislocation. For context, this ratio has averaged between 40 and 60 throughout most of modern history. In recent periods, it has exceeded 80, sometimes approaching 90. This suggests silver is either severely undervalued relative to gold, or gold is overvalued relative to silver, or some combination of both. What makes this particularly significant is the duration of this anomaly. Markets can remain irrational longer than many expect, but they rarely remain irrational indefinitely. Let's examine the supply side of the equation with clear eyes. Global silver mine production has essentially plateaued. Despite higher prices being necessary to incentivize new production, mining companies face increasing costs, declining ore grades, and longer development timelines. The easy silver has been extracted. What remains requires more capital, more energy, and more time to bring to market. Meanwhile, industrial demand continues accelerating. Solar panel manufacturing alone has become one of the largest sources of silver consumption, and this demand shows no signs of slowing. Electric vehicles require significantly more silver than traditional automobiles. Electronics manufacturing, water purification, medical applications, the list of industrial uses continues expanding. The Silver Institute and other research organizations have documented structural supply deficits. This means annual consumption exceeds annual production. For now, these deficits are being filled by above-ground inventories and recycling. But inventories are not infinite. Exchange-traded product holdings have declined as investors sold during price weakness. Government stockpiles from previous decades have been largely depleted. The buffer that has allowed prices to remain suppressed is thinning. And when supply deficits persist year after year, eventually the market must reconcile through higher prices, demand destruction, or both. Given silver's critical role in green energy transition and technology manufacturing, demand destruction seems unlikely. That leaves price adjustment as the primary mechanism for market rebalancing. Now, let's address the monetary elephant in the room. Global debt levels have reached proportions that would have seemed impossible 2 decades ago. Government debt, corporate debt, household debt, all have grown faster than underlying economic output. Central banks responded to recent crises with unprecedented monetary expansion. Balance sheets exploded. Interest rates were suppressed to 0 or below. These policies have consequences. They always do. The debate isn't whether there will be consequences, but what form those consequences will take. Will it be classical inflation, where too much money chases too few goods? Will it be currency devaluation, where the purchasing power of fiat money gradually erodes? Will it be asset price inflation, where stocks and real estate rise while consumer goods remain stable? Or will it be some combination of all three, playing out over years or decades? Silver, like gold, has historically served as insurance against monetary instability, not because it produces cash flow or earnings, but because its value doesn't depend on any government's fiscal discipline or any central bank's policy wisdom. When confidence in fiat currency systems erodes, tangible assets tend to reprice higher. We've already seen this dynamic with gold, which has reached new nominal highs even as real interest rates have risen. Silver has not followed gold's trajectory with the same vigor. This divergence cannot persist indefinitely. Either gold will correct downward, or silver will adjust upward, or both will move to restore historical relationships. Let's talk about something that doesn't appear on charts or balance sheets: human psychology. Markets are not perfectly rational mechanisms. They are collective expressions of human fear, greed, optimism, and despair. Right now, silver exists in what behavioral economists might call a neglect phase. It's not hated, that would require attention. It's simply ignored by mainstream financial media and institutional investors. This neglect creates opportunity, but it also creates discomfort for those already positioned. Holding an asset that everyone else ignores requires conviction and patience. It requires believing your analysis when the market seems to disagree. This is precisely why most investors fail to capitalize on genuine opportunities. They need social validation. They need confirmation from others that they're making the right decision. By the time that confirmation arrives, by the time silver is featured on financial news programs and discussed at cocktail parties, the easy gains have typically been captured. The investors who profit most from market cycles are those who act when assets are unloved, when the narrative seems bleak, when patience is required. Does this guarantee immediate profits? No. Markets can remain mispriced for extended periods, but it does mean that positioning during periods of neglect typically offers better risk-reward ratios than chasing assets after they've already made significant moves. History doesn't repeat, but it often rhymes. Let's examine previous silver market cycles for context. In the late 1970s, silver rose from under $2 per ounce to over $50 in a matter of months. This wasn't primarily driven by fundamentals. It was a speculative frenzy fueled by inflation fears and the Hunt brothers' attempted corner of the market. The subsequent crash was devastating. Silver fell back below $6 and remained depressed for 2 decades. The next major move came in 2011, when silver briefly touched $50 again during the post-financial crisis period. Once more, the move was sharp, dramatic, and followed by a brutal correction. What can we learn from these episodes? First, when silver moves, it tends to move violently. The metal exhibits higher volatility than gold or most other commodities. Second, speculative excess leads to painful corrections. Investors who buy during mania phases almost always suffer. Third, the periods between major moves can be long, very long. Patience isn't just helpful in silver investing, it's essential. Fourth, fundamental improvements don't translate immediately into price appreciation. Markets can ignore fundamentals for years before suddenly pricing them in all at once. Currently, we're in a period that resembles the mid-2000s more than the peaks of 1980 or 2011. Prices are subdued, investor interest is modest, and fundamentals are quietly improving. This is precisely the environment that has historically preceded significant moves, though timing remains uncertain. If you already own silver, you face a different set of considerations than potential buyers. Your primary challenge is psychological, not financial. You've likely endured years of stagnant or declining prices. You've watched gold make new highs while silver languished. You may be questioning your original thesis. This is natural, but it's also dangerous. The temptation to sell during periods of frustration is powerful. Most investors sell at precisely the wrong time, after years of patience just before the market finally moves. If your original reasoning for owning silver was sound, ask yourself, has it been invalidated? Are supply deficits resolved? Has global debt decreased? Have central banks embraced monetary restraint? If the answer is no, then selling out of frustration means abandoning your strategy at potentially the worst moment. However, this doesn't mean doing nothing. Let's discuss intelligent position management. First, ensure your silver holdings represent an appropriate percentage of your overall portfolio. If silver has become too large a position due to other assets declining, consider rebalancing. If it's become too small due to other assets appreciating, you might add modestly. Second, avoid leverage. This cannot be emphasized enough. Holding physical silver or unlevered positions allows you to endure volatility without forced liquidation. Leveraged positions in a choppy, manipulated market are a path to ruin. You can be right about the long-term direction and still be destroyed by short-term volatility. Third, use periods of price weakness to average down if your conviction remains strong and your financial situation allows. But do this systematically, not emotionally. Set predetermined levels where you'll add to positions. Don't chase prices higher, and don't panic sell on weakness. Fourth, maintain a long-term perspective. If you believe silver will eventually reprice higher due to fundamental factors, then quarterly fluctuations are noise. Focus on the multi-year picture, not the daily or weekly charts. Fifth, ignore the commentary that doesn't align with fundamental analysis. The silver market attracts charlatans, promoters, and perennial bulls who predict explosions that never arrive. Trust your own research and analysis, not the breathless predictions of internet personalities. If you're considering silver exposure but don't currently hold positions, your situation offers both advantages and challenges. The advantage is fresh perspective. You're not carrying psychological baggage from years of sideways price action. The challenge is knowing whether current prices represent genuine value or a value trap that could persist indefinitely. Let's address this systematically. First, understand what you're buying. Silver is not a growth investment. It produces no cash flow, no dividends, no earnings growth. It's a hedge, a store of value, and a speculation on monetary policy failure or industrial demand growth. If you need income or growth, silver should represent only a small portion of your portfolio. Second, decide on implementation. Physical silver offers true ownership, but involves storage costs and liquidity challenges. Silver ETFs provide liquidity and convenience, but introduce counterparty risk and don't offer the same security in extreme scenarios. Mining stocks provide leverage to silver prices, but come with operational risks, management risks, and equity market correlation. Each approach has merits and drawbacks. Many sophisticated investors use a combination. Third, consider your entry strategy. Lump sum investing in silver at current levels could work if prices move quickly higher, but it exposes you to maximum risk if prices decline further first. Dollar cost averaging, purchasing fixed amounts at regular intervals, reduces timing risk but means you might miss the bottom if prices move before you're fully positioned. A reasonable middle path might be establishing a core position now, then adding systematically over time, regardless of short-term price movements. Fourth, set realistic expectations. Silver could move 50% or more in a relatively short period if conditions align. It could also remain flat for another 2 years. Investing with the expectation of immediate gains leads to emotional decisions and premature exits. Fifth, determine position size based on your personal risk tolerance and financial situation. As a general principle, assets this volatile should represent a modest percentage of total investable assets. For most investors, 5% to 15% in precious metals overall seems reasonable, with silver representing a portion of that allocation. Younger investors with longer time horizons might allocate more. Older investors approaching retirement might allocate less. One factor that could dramatically change silver's trajectory is institutional adoption. Currently, silver receives minimal attention from large institutional investors. Pension funds, sovereign wealth funds, and major asset managers hold little to no silver in their portfolios. This stands in stark contrast to gold, which has gained acceptance as a portfolio diversifier among institutional investors. Why the difference? Partly market size. The silver market is smaller and less liquid than gold. Partly historical precedent. Institutions have always favored gold, but primarily it's about narrative. Institutions invest based on accepted stories, and silver lacks a compelling institutional narrative currently. This could change if industrial demand continues growing, if supply deficits persist. If gold becomes prohibitively expensive for certain applications, institutional interest could emerge. When it does, the impact on prices could be dramatic. The silver market simply isn't large enough to absorb significant institutional buying without substantial price adjustment. For context, if major pension funds decided to allocate just 1% of their assets to silver, the available supply would be overwhelmed quickly. This represents both opportunity and risk. The opportunity is getting positioned before institutional adoption. The risk is that adoption may never occur, leaving silver in perpetual neglect. As an individual investor, you must decide which scenario seems more probable based on your analysis of fundamental factors and monetary trends. We cannot discuss precious metals without acknowledging geopolitical factors. The global monetary system faces pressures that have been building for decades. The US dollar's role as reserve currency grants extraordinary privileges, but also imposes extraordinary constraints. Recent years have seen increased discussion of currency alternatives, whether digital currencies issued by central banks, gold-backed trade settlements, or blockchain-based systems. Silver's role in this transition remains uncertain, but history suggests that periods of monetary system change tend to benefit tangible assets. Additionally, resource nationalism is rising. Countries that produce strategic commodities increasingly view them as leverage in geopolitical competition. Silver qualifies as a strategic commodity due to its industrial applications. Supply disruptions from major producing countries could impact availability and pricing. These factors don't provide short-term trading signals, but they inform the long-term investment thesis. If global monetary arrangements shift significantly over the next decade, silver's role as both money and commodity could become increasingly valuable. Now, let's address the behaviors that destroy wealth in precious metals markets. These aren't hypothetical warnings. These are patterns observed repeatedly across market cycles. Buying because prices are rising and everyone is excited, then selling because prices are falling and you're discouraged. This guarantees buying high and selling low. Successful investing requires doing the opposite of what feels comfortable. When silver is boring, consider buying. When it's exciting, consider selling. Leverage in precious metals should be approached with extreme caution, if at all. The volatility is too high, the manipulation too prevalent, and the timing too uncertain. Even if your long-term thesis is correct, leverage can force you out of positions at the worst possible moment. If you cannot afford to own silver without borrowing, you cannot afford to own silver. Silver should not represent your entire investment portfolio. It should not even represent the majority of your precious metals holdings. A balanced approach might include silver, gold, productive assets, cash reserves, and other uncorrelated investments. Concentration creates unnecessary risk, regardless of how confident you feel about any single asset. No one knows where silver will be in 6 months, 1 year, or 5 years. Anyone claiming precise knowledge is either dishonest or delusional. Make decisions based on fundamental analysis, risk management, and personal financial circumstances, not on someone's prediction of $100 silver by next year. If you own physical silver, you must address storage properly, telling everyone you own it, keeping it in obvious locations, or failing to ensure it adequately creates unnecessary risk. Privacy and security matter. Plan accordingly. Mining stocks offer leverage to metal prices, but they also offer leverage to operational failures, management incompetence, regulatory changes, and equity market crashes. If you invest in miners, do so with eyes wide open to these additional risk layers. The lowest prices often occur when frustration peaks. The moment when you most want to sell is often precisely when you should be holding or buying. This is counterintuitive and psychologically difficult, but it's also one of the most important principles in contrarian investing. If you don't understand why you own silver, you'll panic when challenged. Develop your own thesis through research and analysis. Don't buy because someone on the internet said to. Buy because you understand the fundamental case and accept the risks. In many jurisdictions, precious metals face different tax treatment than stocks or bonds. Understand the implications before trading. Premature selling to avoid unrealized losses, only to face tax consequences on other gains, represents poor planning. Silver at $30 per ounce isn't necessarily better than silver at $25 if fundamentals have improved substantially. Price is what you pay. Value is what you get. Focus on value, not just price. This topic deserves special attention because it shapes how investors think about precious metals. Traditional thinking suggests silver thrives in inflationary environments and suffers in deflationary ones. Reality is more complex. In the 1930s, gold was revalued higher by government decree during a deflationary depression. The purchasing power of gold increased dramatically even as general prices fell. Why? Because deflation was driven by credit collapse and loss of confidence in the financial system. Hard assets became valuable precisely because financial assets were suspect. We may face a similar dynamic in the future, not deflation in the 1930s sense, but a loss of confidence in debt-based monetary systems that drives demand for tangible assets regardless of general price levels. Alternatively, we may face inflation as governments and central banks attempt to inflate away debt burdens. This would also benefit silver, though through a different mechanism. The point is this: silver can thrive in multiple scenarios. What matters isn't whether we get inflation or deflation per se, but whether faith in fiat currency systems remains intact. If that faith erodes for any reason, tangible assets become increasingly attractive. When will silver move significantly higher? This is the question everyone wants answered. The honest answer is, I don't know, and neither does anyone else, but we can identify conditions that would likely trigger repricing. First, a major supply disruption. If several large mines face unexpected closures, or if a major producing country restricts exports, the market would adjust quickly. Second, a visible shortage in industrial markets. If solar manufacturers or electronics companies struggle to source adequate silver, prices would respond. Third, a loss of confidence in paper silver markets. If investors increasingly demand a physical delivery rather than trusting exchange-traded products or futures contracts, the fractional reserve nature of these markets could be exposed. Fourth, a monetary crisis. If a major currency faces rapid devaluation, precious metals would likely surge as safe haven demand increased. Fifth, institutional adoption. If pension funds or sovereign wealth funds decide silver deserves allocation, their buying power could overwhelm available supply. Any of these catalysts could emerge tomorrow, next month, or next year, or they could develop slowly over many years. This uncertainty is precisely why position sizing and patience matter so much. Central banks don't buy silver the way they buy gold, but their policies affect silver profoundly. Every round of quantitative easing, every interest rate suppression, every expansion of central bank balance sheets represents a debasement of fiat currency. This doesn't cause immediate inflation at the consumer level. Inflation depends on money velocity and credit creation, not just money supply. But it does undermine the long-term purchasing power of currency and create conditions where tangible assets eventually reprice higher. Recent years have seen unprecedented policy experimentation. Negative interest rates, yield curve control, direct government financing through central banks all represent departures from the historical norms. These experiments have consequences. We're living through monetary conditions that have never existed before at this scale. Silver, as both a monetary metal and industrial commodity, offers exposure to the potential outcomes of these experiments without requiring certainty about which outcome will prevail. Let's make this concrete with a framework for thinking about allocation. This is not investment advice. Your situation is unique and requires personal analysis, but rather a thinking framework. Consider your total investable assets. This excludes your primary residence, emergency funds, and money needed for near-term expenses. From these investable assets, determine what percentage represents speculation versus core holdings. Core holdings might include retirement accounts, diversified equity positions, and fixed income appropriate to your age and goals. Speculative holdings represent capital you can afford to lose without compromising your financial security. Silver belongs in the speculative bucket for most investors, though some might argue for a small core allocation as portfolio insurance. Within your speculative allocation, diversify across multiple themes. Perhaps some growth stocks, some value plays, some precious metals, some alternative investments. Silver might represent 20% to 50% of your precious metals allocation, with gold and possibly platinum comprising the rest. This framework ensures that even if silver performs poorly, your overall financial health remains intact. It also ensures that if silver performs dramatically well, you capture meaningful benefit. One of the hardest aspects of silver investing is enduring periods when nothing happens. Stocks pay dividends and report quarterly earnings, providing regular feedback. Real estate generates rental income. Bonds pay coupons. Silver just sits there, shining mutely, providing no income and no regular validation of your investment thesis. This psychological challenge causes many investors to abandon positions prematurely. How do you maintain conviction during these periods? First, regularly review your original thesis. Has anything fundamentally changed? If not, the wait continues. Second, focus on what you can control. You cannot control silver prices, but you can control position size, storage arrangements, and portfolio balance. Third, avoid checking prices obsessively. Daily or weekly price movements in silver mean very little. Monthly or quarterly reviews are sufficient for long-term investors. Fourth, maintain other interests and investments. Silver should not dominate your mental energy or emotional state. Fifth, connect with other thoughtful investors who understand the long-term case. Not to create an echo chamber, but to counter the mainstream narrative that ignores or dismisses precious metals. The ability to wait with confidence separates successful investors from the crowd. Silver mining, like all extraction industries, involves environmental and social considerations. Modern mining operations vary widely in their environmental practices and treatment of local communities. If these issues matter to you, investigate the companies you invest in, whether directly through mining stocks or indirectly through the origin of physical silver you purchase. Some producers have embraced higher environmental standards and community engagement. Others maintain minimal compliance. Your investment dollars support one approach or the other. This doesn't mean avoiding silver entirely. The metal serves critical functions in green energy and technology. But it does mean exercising discernment about how you gain exposure. Additionally, recycling plays an increasing role in silver supply. Supporting companies and products that facilitate silver recovery reduces the need for new mining. These considerations don't change the fundamental investment thesis, but they add dimensions that some investors find important. One factor that could dramatically increase silver demand is a technological breakthrough in areas where silver plays a critical role. Energy storage systems, water purification at scale, advanced medical treatments, all represent potential demand drivers that don't exist in current forecasts. Conversely, technological substitution could reduce demand if engineers develop alternatives that perform silver's functions at lower cost. This uncertainty cuts both ways. As investors, we must acknowledge that technology can shift demand patterns in unpredictable ways. However, silver's unique properties, highest electrical conductivity of all metals, highest thermal conductivity, antibacterial properties, reflectivity, make substitution difficult in many applications. The cost of silver in most end products is low enough that engineering around it often doesn't justify the effort. This suggests demand growth from technology and green energy represents a more likely scenario than demand destruction from substitution. If you're serious about silver investing, continuous learning is essential. Understand how futures markets work, even if you never trade futures. This knowledge helps you interpret price movements and market dynamics, follow supply and demand data from credible sources. The Silver Institute, GFMS, and CPM Group publish regular research. Learn about mining economics. Understanding all-in sustaining costs, reserve replacement rates, and production trends provides context for price analysis. Study monetary history. Understanding how currency systems have evolved and failed provides perspective on current conditions. Read broadly, including perspectives you disagree with. Echo chambers create blind spots. The most successful investors continuously update their understanding as new information emerges. Let's end our analysis with a different kind of framework: regret minimization. Imagine two scenarios 10 years from now. Scenario 1, you invest in silver at current levels. Prices remain flat or decline. You lose some capital or miss opportunity costs from other investments. Scenario 2, you don't invest in silver. Prices rise dramatically due to supply shortages, monetary crisis, or institutional adoption. You watch from the sidelines as an opportunity passes. Which scenario would you regret more? If losing the capital you'd invest in silver would cause serious financial hardship, then obviously you should not invest or should invest much less. But if you can afford the potential loss, many investors find they'd regret missing a major move more than they'd regret losing modest capital. This isn't a recommendation to invest recklessly. It's a framework for thinking about decisions under uncertainty. You cannot eliminate regret entirely, but you can choose which regret you're more willing to accept. We've covered substantial ground. Let's synthesize the key points. Silver stands at a unique moment. Fundamental factors, supply deficits, industrial demand growth, monetary policy extremes suggest current prices may not persist indefinitely. Yet markets can remain irrational for extended periods. Timing is uncertain. Volatility is guaranteed. For existing holders, the path forward requires patience, position management, and emotional discipline. Avoid leveraged bets, maintain appropriate diversification, and focus on the multi-year picture rather than quarterly noise. For potential investors, the case for modest allocation appears compelling, but implementation matters enormously. Dollar cost averaging, appropriate position sizing, and realistic expectations determine whether silver exposure helps or hurts your financial outcomes. For everyone, regardless of current position, certain principles apply universally. Don't invest based on hype or fear. Invest based on fundamental analysis and personal risk tolerance. Don't use leverage in highly volatile markets. The risk of forced liquidation at the worst moment is too high. Don't put all your eggs in one basket, no matter how compelling the thesis. Diversification protects against unknown unknowns. Don't make decisions based on short-term price movements. If your time horizon is measured in years or decades, weekly fluctuations are meaningless. Don't follow the crowd. By the time mainstream consensus embraces silver, the easy gains have been captured. Do your own research, develop your own thesis, make your own decisions. The title of this discussion suggested that investors are running out of time. That's partially true. The window for positioning at historically suppressed prices will eventually close. Supply deficits cannot persist indefinitely without price adjustments. Monetary excess eventually produces consequences. But running out of time doesn't mean panic. It means awareness. It means thoughtful preparation rather than reactive scrambling. The investors who will benefit most from silver's eventual repricing, if it occurs, are those who position methodfully now, who size positions appropriately, who avoid leverage, and who maintain conviction through inevitable volatility. This is not about getting rich quickly. It's about prudent portfolio construction in an environment of unprecedented monetary experimentation and growing supply constraints. It's about recognizing value when markets don't, about maintaining patience when others grow frustrated, about thinking in years when others think in days. The future is uncertain. Silver may vindicate the bulls spectacularly, or it may continue frustrating them for years. What you can control is your approach, thoughtful, disciplined, emotionally balanced, and appropriate to your personal circumstances. That approach won't guarantee profit, but it will ensure you're positioned to benefit if fundamentals eventually overcome market inertia, while protecting you from ruin if they don't. The choice, as always, is yours. Make it wisely. Make it based on facts, analysis, and honest assessment of your risk tolerance. And once made, have the courage to maintain your conviction through the noise, the doubt, and the inevitable periods when nothing seems to happen. Because if the fundamental thesis is correct, those quiet periods are precisely when fortunes are built, not through dramatic action, but through patient, intelligent positioning. Thank you for your time and attention. May your financial decisions be thoughtful, your risk management sound, and your patience rewarded.